I would actually view the unemployment number as the more important number. I mean, I think people are missing the forest through the trees here a little bit. I mean, nothing really changed today, Melissa. The Fed has been pretty unequivocal in its hawkishness since Jackson Hole, and they continue to be so today. And I don't think it really matters, quite frankly, whether the Fed gets to 5% or 5.25% or 4 3/4. The point is they're going to be restrictive, and they're going to get too restrictive, and they're going to bring down long-term growth. That's the goal. That's what they're trying to do. So let's look through today and instead think about what is the end game here. And the end game is not cutting rates, at least not for any time soon. The end game is to slow growth and slow the economy.
I completely agree in terms of what the Fed has been saying. The Fed has been very consistent, I believe, in its message. But the markets, in terms of how they interpret it, they want to hear what they want to hear. And so there's an issue of positioning here, especially as we've seen that rally from 34-something to where we are.
Well, I think the one other thing that was said today that was different was everyone was thinking, well, the Fed has never stopped until the Fed funds rate is higher than inflation. And he backed away from that for the first time today. I think that was bullish, right? That was dovish. Is that fair or no? I mean, that's different. So the cumulative statement, I will stop before we raise the Fed funds rate above.
So you're one of those people who wants to hear dovish.
No, I'm trying to figure out maybe. I mean, I want markets to go higher. I just think that's a little premature. I think we front-loaded this rally. So Guy pointed out 4,200 in the S&P. We were on a tear to get there. So I thought we were going to have a soft patch in October, back up, and then after midterms rally into year-end. I think we pulled forward that. But after midterms, I think we could rally again into year-end. So for different reasons, for not the Fed any longer, for different reasons. So I was looking for 3,300 in the S&P. We didn't get that. We didn't trade down that level. So I think we all have to be a little more poised of where we think year end is. But I think midterm elections, we rally from that point on.
You're trading this turnaround here.
Yeah, listen, I think the Fed had a look at that Friday jobs report. And I think that's one of the reasons. I mean, I was just amazed at watching CNBC today. Oh, my God. I mean, why wouldn't they? Why would you make a decision like this?
Not available to them?
Well, of course it's available. It was October data. And here we are, November 2nd. I mean, they have the data. So I think they saw it. I think, too, the point is, I think it's probably going to be hot, meaning, like, you know what I mean, as we think about.
He's preemptively being hawkish.
Yeah, I think he is. Okay, so I think that's going on. I think the other thing is we talked today, we have a call at 12:30, and I was saying I thought the price action in some of these tech stocks was absolutely disgusting. And it reminded me of the sort of moves we saw when interest rates were careening higher and we really didn't know where they were going to stop. And to Michael's point, we kind of know where they're going to stop. It's not too much higher than where they are right now. But if you look at those mega cap tech stocks, okay, the leaders of this bull market, the way they were acting today before the data came out, okay, or before the meeting, and then the way that they fell out of bed at the end of the day, and then also pre-meeting, the way some of these growthier names, as our friend Sandy would call them, you know, these stocks that have been down 70, 80%, they don't actually have the growth anymore. They still have the valuations relative where growth is expected. They were acting horribly. So to me, I think we go lower. Stephen, I'm going to tell you, man, I don't think 3,400 or 3,300 is out of the woods in 2022 at this point, because I think the Fed is not particularly worried about the stock market right now.
So you don't think we get this is where I'm confused with the timing of it. You don't think we get the rally going into year end. You think from now it's the correction, discounting this Powell meeting going into year.
I thought this rally was so pathetic, like that we had since October 13th, relative to the one that we had over the summer, relative to the one that we had in March here. And I think about, we said this on the show last week, think about how much more we know than the last time the market was rallying. We're pretty certain that by mid-year, this huge contributor of energy, okay, if you think about it, to S&P earnings is going to be going away, okay? And it's a small percentage of S&P earnings. And really what you're left with is a really slow growth environment with the S&P not troughing. It's not troughing at 17 times, people.